up and running. Let's see what we can get done today. Been a morning, right? Did you guys see that news spike? Holy smokes. Good morning, Luciano. Good to see you. Guys, today is Wednesday, December 11th. And man, at 8:30 a.m. we got all these CPI numbers in. And whoa, NASDAQ went absolutely nuts. And then I missed the best trade ever because I was answering messages. Man, not my money. Hey, Miraboy. And I'll tell you what, it's tough whenever you have one of those and you're like, oh, I missed it. No, you're good, Marty. You got to say to yourself, it just wasn't mine. Don't try to make it up. Don't try to make something happen that isn't rules-based because you didn't get that one that you think you should have been in. And man, I had to work that one today. Full tilt boogie. 10:30 a.m., guys, we have crude oil inventories. So those of you that are trading crude oil, remember that can create a spike. And it may be just what you need to rattle loose to get that momentum trade you're looking for, set up those trend trades. And then there's not a whole lot going on. It's all low impact after that. So every morning, man, this is the first thing I do, is I go through and I check my news and I choose not to trade into news. I usually use that little window before to go make a little breakfast. Whoops, we're going to go to the Nexgen page, guys, because this is where it all comes from. I mean, everything comes from the Nexgen page. Everything comes from the education page, specifically the trading guide. I mean, every rule that I talk about, all the terminology that we use, it's all available for you right here. If you go to the frequently asked questions, common terms, scrolling on down, if you're curious what a stop is, what a tick is, what a target is, it's all there for you. But what we're going to talk about this morning, it's kind of what I talked about yesterday, probably what I'll talk about tomorrow, is we're going to talk about a high probability trade. Why? Because each indicator on every chart agrees with the rules for this trade, guys. Your triggers are the strongest. There's no trouble between you and your entries, no termination conditions. And guys, we talk about this trade and we break it down and we look at it and we learn how to study it and we learn how to enter and how to manage. And everything that you will need to be successful with this software comes to you in the first hour, hour and a half. The only thing that Nexgen cannot provide you is the experience to be comfortable with the setup, is the experience to trust the methodology. But I'm going to teach you how to study it. Good morning, Sid. And I want you to put me through the ringer, guys. Everything that I say, I don't want you to believe me. I want you to go study it. I want you to test it. I want you to prove to yourself that it's true. Because what happens is you guys that are willing to put in that level of work to prove that I'm full of beans, you're with me for the rest of your lives. You're with me forever. Because you can't prove that what I'm talking about today doesn't work. It really does. This high probability trend trade, it is 3 rules, guys. And that's it. It's just 3 rules. And this is the trade that typically wins 70 to 80% of the time when you follow those rules, guys. This is the trade that, because of that level of success, it creates confidence, because they say that confidence comes from the memory of success. And guys, this is the trade, most importantly, and this is why this big slide's up on your screen. It teaches you to read your indicators. I want you to be a chart reader before you're a trader. I want you to be able to look at your charts and recognize advantages, guys. And once you can do that, that's when you cross that threshold into becoming a day trader. 90% of your day, each and every day, is doing nothing. 90% of your day is waiting. Is looking for advantages. And man, when those advantages are present, that's when the trading starts. That's your 10%. But once you're good at being a chart reader, and guys, my whole job, my purpose in this world is to make you a chart reader, to help you and teach you. You're going to understand where the market is likely to continue. This likely to continue point initially is your entry for the highest probability trend trade. It will also, as you grow as a trader, develop into your entry for a high volume area trade. It will find its way into your trading plan as the entry for a momentum trade. So understanding where the market is likely to continue is going to be that great thing that gets you into the market. You're going to understand where it's likely to go. And this is going to help you create solid expectations as you develop a management plan. And then most importantly, you're going to understand where the market is likely to stop. And this is what we call a termination condition. And these are the big lines on your chart that say, hey, no more trades, don't do it. We could create a bounce. Something could go wrong here. And you're going to know how to identify those, and you're going to be ready for them long before you ever reach them. So the high probability trend trade is 3 rules. Each rule creates an advantage. So when rule number 1 is true, is met, is factual, you will have the advantage of momentum. You'll have a market that's likely to continue in the direction of the trend. When rule number 2 is in play, you'll have a clear path. There's going to be nothing in your way, none of those likely to stop areas, and this is going to give you room to your profit targets. And then number 3 is specific to the highest probability trend trade that we teach. Number 3 is going to put you into the market where the market is most likely to continue. Hey, good morning, Jeffrey. Nice to see you this morning. I want you to commit. Give me 1 solid week of just not caring about the trades, but focusing on the advantages, guys. Because once you understand momentum and clear path, once you can identify strong triggers and termination conditions, that's what opens the door. That's what sets you up for the next trades. That's what gets you in a position where you can manage appropriately, maybe aggressively. Sorry, my dog just got hold of a squeaky toy and it scared the heck out of me. These 2 advantages, guys, these are the 2. This is the base. This is the foundation. This is where great things happen for you as a trader. These 3 rules are going to happen on only 2 charts. And I'm getting t-shirts and coffee cups and all these things that say the large chart leads the way. Because the large chart is what's going to tell you that it's time to look for an entry, guys. The large chart's a very slow-moving chart. It's difficult to see the market change on this large chart because it is a very broad stroke of a brush. The large chart defines the direction you should be looking for your rules to be met. The large chart defines the momentum in the market through rule number 1. And the large chart will show you those areas that could be problematic. And all of this happens on the most current bar of the large chart. The first bar, 1 bar. How easy is that? You don't have to search and go back and do historical studies and see if the orange juice froze or if the crop reports are good. Guys, look at the first bar on your large chart, and it's going to define direction, momentum, and areas. And once the large chart says, let's look for an entry, you have momentum, your path is clear, we're going to turn to a small chart. This is a fast chart. This is a refinement chart. And what happens inside of 1 bar on the large chart is 20 to 30 bars on the smaller, faster chart. This will allow you to pinpoint your entry. This is going to reduce your risk. This is going to maximize your profit potential. And guys, your small chart is an entry chart when the rules are met. Don't get sucked into the sexy small chart and take trades without those advantages in place. It looks very much like this. I'm glad somebody caught that. In that 1 bar on the large chart, there is a black box around that 1 bar. That black box carries over to my small chart, guys. And you can see a big retracement. You can see it bounce off of a line, and you can see it head back in the direction of the trade. All of this happens in this 1 bar. So this 1 bar never changes the advantages that it gives you. And this refinement process is going to have you pinpointing that pullback to an area inside of triggers. On your large chart, it just looks like it sprouted a tail. We don't trade these tails, guys. They're just too slow, too hard to recognize. That refinement process is going to have you pinpointing precisely where that tail is most likely to form. So we use these 2 charts. This is my favorite picture, I think. Who are you trading with and who are you trading against? Guys, the big charts, they define the areas, they define the direction. The large chart is a reflection of the large crowd opinions. And I want you to think of the large crowd. These are the institutions. These are the people that trade thousands of contracts. These are the people that have billions and trillions of dollars. These are not you. These are the people that you want to be trading with because they are going to create the trends. They're going to establish the momentum. And they're going to react at those key Fibonacci areas on your large chart. And guys, Going with the large crowd is typically the path of least resistance. But of course there's a small crowd, right? There's always an opposite. This small crowd is a bunch of yahoos that have a lot of money and a considerable amount of influence. But they love to fight the large crowd, whether it's to push it down to get a better entry, whether it's because they're just arrogant, who knows? But what happens is these guys typically fail 70 to 80% of the time on their little endeavors fighting what the large chart says. Your entry rules have you pinpointing right where their failure is most likely to happen, right where the trend is most likely to continue, guys. And it's that small crowd that gives us this shove. And we're going to capitalize on the small crowd, because if they lose 70 to 80% of the time, well, that means we have the potential to win these trades 70 to 80% of the time. And the rules that we're about to cover, guys, it's nothing more than a pattern. It's just a pattern that has been tested, it's been verified, it's been validated, and dag nabbit, it's been proven that this pattern wins more than it loses. And I don't know if you guys knew this coming in here, but trading is about taking more out of the market than it is putting into the market. And that's exactly what we're going to talk about for the next hour. We're going to talk about the rules, the Fibonacci and the trigger line rules for when it's okay to trade. When is it okay to trade? When my rules are met. When is it not okay to trade? When my rules aren't met. Why? Because my rules provide me a statistical advantage. Guys, there's a two-piece path to getting to where you want to be ASAP. Is there anyone in this room that doesn't want to be a successful day trader sooner than later? Of course not. You don't even have to answer that. What a ridiculous question, guys. It starts with posting your trades in the class. Every time you post in my room, it's a private session. Every time you take a trade, drop it in the room, we'll talk about it. Every time you see something you don't understand, take a picture, drop it in the room, we'll talk about it. Every time you work on a management plan, drop it in the room, we'll talk about it. Guys, you get my undivided attention every time you post in this room. So simulate, practice, take pictures, and get those pictures to me and tell me what you see so we can make sure that you're seeing it correctly. And we'll work together to make sure that you're following rules. We'll work together to make sure that you're embracing advantages. We'll work together to make sure that you're not just getting lucky, because luck tends to run out the second you go live. So post in the room lots. And then we're going to simplify. We're going to focus on nothing but really the entry for the high probability trend trade. We're not even going to talk about how to get paid from it. We're going to talk about how to pinpoint that area where the market is most likely to continue for an entire hour. I'm going to show you what it looks like, each rule individually. I'm going to teach you how to study it. I'm going to give you materials to help you study it. You've got to know what the looks are that you're going to commit to. And we talked about this yesterday a little bit from some great input from the class. What's it look like live? Guys, it looks live exactly what it looks like still. And the more pictures you take of the looks that you'll commit to, the easier it is to catch it in a live market. And you've got to learn these looks so that they become easy. And that's the second piece of becoming a confident trader ASAP. I'm going to give you this spreadsheet. I'm going to drop it in the room right now. And for you guys that don't have Microsoft, thanks Marty for pointing this out this morning. For you guys that do not have Microsoft, there is this openoffice.org, and it'll allow you to use Microsoft products with all the functionality. Pop it in, use it so that you can get these. That was a little heads up that I probably need to start sharing every day. This trade tracking sheet, guys, this does a lot for you, honestly. The first page is trade tracking. And all that is we're talking about the idea that each and every time you take a trade, there's going to be information. There's going to be things that are going to make you better tomorrow. So every time I take a trade, I'll go through. Which one, Rob? About the open office so that you can use Microsoft stuff, or about use that darn spreadsheet? If you don't have Microsoft, the link that is just above you in the chat box, openoffice.org, will allow you to use those Microsoft products. It'll allow you to use that spreadsheet to see the Word documents, all that good stuff. Guys, every time I take a trade, I have to come through and I have to annotate my charts and talk about what I see. And I'm going to share these links to screencast So every time I take a trade, I want to drop a picture in here, guys. I want to take that screencast link, that upload. You're going to get it from TechSmith Capture, from Snagit, however you're taking pictures. And it puts this big screencast link up here. And guys, that's too much for my brain. So I'm going to go to the Insert tab, and I'm going to go to the Link button. And guys, this is going to allow me to create a hyperlink. So I'm just going to paste that link into there, that screencast.com, and I'm going to call it Awesome Long Trade, or whatever you want to call it. And did I have momentum? Absolutely I did. Let me fill out that spreadsheet because I'm reinforcing the idea that I want advantages. Did I have a clear path? You better believe I did because I'm following rules. How did I do? Well, I made $500 and it felt good. And then here's the most important thing you can do with this sheet, I think, is go to the feedback from class and say something like perfect, never miss, right? Or maybe say into a term, or into a term, or into a term, right? Over and over. Because what happens is you're going to come back and study this sheet every morning. And you're going to see what you did yesterday, and you're going to say to yourself, holy crap, this is amazing, this keeps working. Or, egads, this keeps taking money from me. I've got to watch this. And you're going to see things feel easy, and you're going to have things that feel forced. And guys, this little historical study each and every morning, it sets you up for the day. Keeps you focused on the good, keeps you focused on avoiding the bad. It's going to accelerate the learning. And if you come through and you see indetermination condition 3, 4, 5, 6, 7, 8, 9 times, guys, this is your thing. This is the thing that I'm going to recognize. This is the thing that you need to recognize to eliminate that from what you're doing. And you and I will work together because you're showing me a picture of what you're doing, and we'll come up with a plan so that you can avoid these things that are robbing you of your success. The basic rules tab. This is the rules for the high probability trend trade highlighted in green. It's a picture, but it's a picture with writing. It's a picture that not only shows you what it means to have strong triggers, but it describes it and it lets you know what the advantage is. And then I'm a big fan of equal and opposite. There's weak triggers. So you have pictures of rules being met and pictures of rules not being met. And this goes all the way through the rules, guys. This is going to be your study tool. This is what's going to help you become a chart reader faster. And then we have the client trades. This is almost 400 pictures of you guys being brilliant and me stealing your brilliance to put in as a study guide for the new users. There's the entry sequence for the high probability trend trade long and short. You should be able to go through this and know the language in your sleep, guys. There's management ideas. There's patterns that repeat themselves. When you become a chart reader, stuff's going to jump out at you. Take pictures of them. There's even a management plan for you guys. And then the final tab is where you take your pictures and you make your sheet look like the sheet that I put together for you. You start taking pictures of that perfect trade setup that you want to be in because you're committing it to memory so that it becomes easy. You're eventually going to have to do something with that great entry, and this is where management ideas come in. Every picture you post in my room, show me start to finish. We'll work on your management plan together. And then the things that begin to jump off the page at you, guys. These are the patterns that repeat themselves. These are the gap theory. These are 3 divergences in the same price range. These are all the different things that you're going to start to recognize once the ideas of momentum and path become easy. You're going to see a lot more. So we're going to get rocking this morning. We're going to talk about the rules. You guys are going to practice. Guys, there is 0 excuses. I want you posting in my room. And let me do this real quick. Oh, Mark, I don't have capture software. Yeah, you do. It's on your computer. When you learned, or when you signed up for the demo, you got it. But I'm going to remove all excuses. Capture software takes 2 minutes to download, to put on your computer, to be fully functional and allow you to post in my room and get those links so that you can fill your spreadsheet. If you need a tutorial on how to use this, if you want me to run through it, guys, I'm gonna not only give you that fish, but I'm gonna teach you to fish. Here's everything you need to know about posting in my room. So let's get to the rules, guys. There's only 3. It shouldn't take long, right? Well, it's going to take a minute because I say the same thing 1,000 different ways because everybody hears things a different way. So if I don't say it in the way you need it said, I want you to go, hey Mark, let's rephrase that. Let's clarify. Let's get that so that it sinks in. And it all starts with strong triggers, guys, and it all starts on the large chart. Strong triggers. Why? Because it gives me the advantage of momentum, and momentum is pretty kick-ass. So we're going to let the large chart do its work. The first thing it's going to do is it's going to define the trend. Is it going up or down? If the background's green, it's going up. If it's red, it's going down. My job as a brand new user is to look for my rules to be met to go in the direction of the trend. These colors pay dividends because the only way I can have a strong trigger line in an uptrend is if all my colors are green. If my background is green, if my large triggers are green, if my small triggers are green. In a downtrend, everything's got to be red. Background, small triggers, large triggers. Guys, this is a little safeguard for you. This is like a, hey, whoa, let's make sure that we have the best of the best. What strong triggers is it means that your small triggers are up and above the large triggers. It means that your large triggers are wide. Guys, I'm going to type that in the room, all caps. Large triggers are wide. They're open like Pac-Man. And it's the space created between the two. It's that gap between the small and large. It's the separation. That's what lets me know that I have strong triggers. And when I have strong triggers, whether it's up or if the small are below the large are wide and the space is here and it's all red, guys, the odds are favorable for the market to continue up. The odds are favorable for it to continue with the trend. Strong triggers are what pushes that market. Strong triggers, that momentum that they create has the potential to break key areas. And strong triggers, one of my favorite things about it, it can cover mistakes. It can save your bacon every now and then because it's hard to stop a large chart that is moving with odds favorable momentum in the direction. So guys, this is your best look. This is your strength look. And there it is right there, strong triggers. Smalls separated, everything's cranking. It did break an area, and then it turned into what we call weak triggers, where those small triggers work their way inside of the large triggers. This is weakness. This is a visual that the trend is slowing. This lets you know that the momentum is dying. And when I have weak triggers, anything can happen up or down. And man, we just saw this go in the other direction on crude oil. Strong triggers is the best. Strong triggers pushes the market. Strong triggers can break areas. This is the best of the best, the highest advantage for taking the high probability trend trade, guys. And if you're a brand new user, let's commit to momentum in the beginning because you'll learn as you grow with the software, as you begin to recognize advantages and disadvantages, when you begin to speak to yourself in those terms. There will be a time when one line works its way inside of the large, but one is still out, kind of straddling that line. And this is a weakness. This is a slowing of the momentum of the trend. You'll still be able to find short trades there when you grow with the software a little bit. Don't panic. We're just building a foundation today. But when those smalls work inside, guys, this is the weakening, the slowing of the trend, and anything can happen. You're going to hear it in class all day long. Anything can happen up or down. And sure enough, we see bigger retracements. We see areas holding. And I'm going to go back to crude oil because this is pretty rad. Weak triggers right at an area and look at the push. Weak triggers right at an area and look at the push. Weakening triggers down in the middle of nowhere and look at the reversal. But notice that from weakness comes strength, and that market rails up and strength pushes down and strength pushes up, guys. So you've got to learn how to trust strength a little bit. You've got to learn how to commit to strength a little bit. And when you look at your charts, I want you to say out loud, I want you to scare your pets, I have momentum. I'm going to look for the next rule. Or I don't have momentum. I'm going to sit on my hands and I'm going to wait until that momentum is present, and then I'll look for the next rule. So could you guys give me a why in the room if you're with me? If you're brand new with me, let me know that momentum doesn't seem like a hard concept. Or let me know that you'd like a little more on it, because I got more. I got pictures for days, guys. You're with me? I like that, Mira, because if you're not with me, you're against me. And then we have trouble, right? Guys, momentum leads the way. And once I have it, I've got to make sure that I have a clear path. Jeffrey, that's then good. You're going in order. What's a clear path? It just means that there's no termination conditions. No areas likely to stop the market. No areas that could create an untradeable bounce. Let's go back to the rules. And let's go to termination conditions. And let's click on that big picture. A termination condition is a Fibonacci-based indicator, guys. And it has the ability to stop the market. Has the ability to reverse the market. These are the lines on your large chart where the large crowd is most likely to make decisions. And we're going to know what their decision is most likely to be based on a comparison of the area and the trigger strength. So what we're going to do is we're going to look at that large chart for horizontal lines. These are the areas where the large crowd might make decisions. This is where the buyers may buy and the sellers may sell. This is where fights can happen and reversals can come true. So we're going to look for divergence highs and divergence lows. And divergence means that the buyers are in control, they're pushing the market up, everything is going their way, and then the sellers not only take over and create that pivot and push it down, but they stole their momentum, guys. And when they steal their momentum, you're going to see that pink line. You're going to see that negative number. And just a heads up, the negative number means nothing. It's a byproduct of the calculation. But this pink line becomes a line in the sand. And if the buyers try to push back up and they hit that pink line, well, that pink line may stop the market. It may reverse it. It could create this big, ugly fight. And the divergence low is just the same thing, opposite. If the sellers are in control and they're pushing down, but the buyers take over and steal their momentum, you're going to see the blue line. And if the sellers come back to the blue line, well, that's a line in the sand. That's where problems can happen. That's an area that could reverse the market. We're also going to have Fibonacci resistance, and when that market's in an uptrend and everything looks like it's going to the sky, these red lines may stop the market. They may create untradeable bounces. They could even reverse it completely. And if the market's trending down and it reaches one of those areas of support, this area of support, this blue Fibonacci line, guys, it may stop, bounce, reverse. This is where decisions are being made. And then finally, there's these yellow 1-to-1s. And guys, these are cool because these are Fibonacci areas that print real time based on previous swings. And they become very powerful. And if the market is trending up, they could behave as resistance. And the market's trending down, it could behave as support. And guys, each of these horizontal lines on a large chart, think of it like that. It's just a line on a large chart. This is where decisions are being made. So here's the recipe for identifying a termination condition. Everything begins with price reaching the area, meaning that your dynamic Renko bars reach Fibonacci resistance. They reach a divergence high. They reach yellow 1-to-1s. This sets off the decision-making process from the people in control or the people that are fighting the people in control. So once price reaches resistance, divergence high, yellow 1-to-1s, all you have to do is ask yourself, where are my triggers? And guys, I would encourage you, write that down on a piece of paper. Price reaches an area, where are my triggers? Price getting there is the only thing that we use price for in the high probability trend trade. The triggers let you know that if they are below resistance, then this is a termination condition. And this area could create a big untradeable bounce. You shouldn't anticipate anything, Jeffrey. You shouldn't anticipate anything. Listen to exactly what I'm saying and be hyper-focused. When price reaches an area, where are my triggers? So check this out. Let's do this real quick. I think I just found your brain and how it's thinking. So check it out. This is resistance. This could also be a divergence high. This could also be, let me go to the pen here and we'll make it yellow. This could also be 1-to-1s. So any form of resistance, whether it is, come on now, I'm trying to make dots. All right, we'll do that. There's my yellow 1-to-1s. So any form of resistance, price reaches it. And once price reaches it, I'm done. Done with price. Doesn't matter. It's all triggers. And if they remain below, it's a termination condition. No trades into that area. And if they remain above support, it's a termination condition. No trades into that area. So price reaches, where are my triggers? Triggers tell the story. And this is exactly what it looks like when there's a termination condition. And Jeffrey, the one thing that I want you to avoid is don't separate resistance from one-to-ones from divergence highs. They are all equally as impactful. Does that make sense? So whether it plunges through one-to-ones, support, resistance, divergence lows, it doesn't matter. If it reaches the area and the triggers don't break, sit on your hands. And here's your plunge picture. So again, this could be support. This could be a divergence low. This could also be yellow one-to-ones. It could be any of those things here. Let me see if I can find like just a blob. We'll do this. So here's your one-to-ones. I love that question. Thank you. When price reaches it, it's a termination condition. The triggers are still above. Let's sit on our hands and let's do a whole lot of nothing and see what happens. Are you with me so far? And remember, it's the triggers that tell me that. So Jeffrey, there is this time where as a brand new user, you're going to do nothing. You have to sit on your hands. You have to literally say to yourself, I don't have any idea what's going to happen, so it doesn't do me any good to anticipate what may happen. What I can say is that if the market reverses off of this area, well, then I'll look for long trades. But you can also say, if my triggers break through, both small and large, well, then that area is broken, and then my path is clear. So there's always an if-then, but I'll never know. I try not to anticipate because, Jeffrey, I believe my own BS. And if I anticipate something to happen, I try to take trades on my anticipation. But if I wait for it to happen, if I wait for the small and the large triggers to get below support, well, then I know support is broken. And then I know that my path is clear until I reach the next area. Does that make sense? So from the point of termination condition to clear path, there's a transition area. There's these times where the market hasn't broken the area yet. It's not a clear path, so I'm sitting on my hands. But Jeffrey, there is a moment with this level of momentum where you can say the area has the potential to break because of the strength in the triggers. And when the small triggers break through but the large triggers remain above, you can say this area has the potential to break. If it does, I'll take my short. And I'm going to give you a plan to be able to catch trend trades on this potential, but it's a different set of rules that require an understanding of the high probability trend trade. So I'm going to stick to the trend trade right now. Does that make sense? Everybody in the room. Guys, there's going to be times where it sounds like I'm talking out of the side of my neck, and I think it makes sense, but it doesn't to you. Make sure you tell me if this is one of those times. So we get back to, and this is why we don't always anticipate. Price reaches support, triggers remain above, I have to sit on my hands. And then just a moment later, price reaches support, the triggers remain above, and I have to sit on my hands. And then just a moment later, that's it. That's it, Jeffrey. Let the triggers tell the story. Price getting there sets off the decision-making process, but the triggers tell the story. And we'll go back to the live market and look at it too. There's going to be times when areas are stacked, where it's support after support, resistance after resistance. And guys, you're like, crap, I don't have a clear path. My rules aren't met. I can't take a trade. That's okay. This is 90% of your day. 90% of your day is being patient, is waiting, is doing nothing, just hanging out, relaxing. The futures markets, guys, they trade. The futures markets trade on average $220 billion every hour. On average, $220 billion in hours. You don't need every move. You don't have to catch every swing. You don't have to hold for the duration. Guys, our job is to capture money, is to capture funds based on a pattern that's been proven to win more than it loses. And when you focus on having your rules met, what you find, Jeffrey, this is a good one, is that when you're trading away from areas and trading to areas as your target, it's that void in the middle of the decision-making process. This is where the easy money happens, guys. This is where the high probability trend trades happen. This is where things get fantastic for you. So when we talk about termination conditions, areas break, or I wouldn't tell you what it looks like when they break. This was pre-Thanksgiving, and I love this picture because there were 26 times that the rules for termination conditions kept you from taking a loser. There were 6 times where the area broke. So guys, it's not the one time that it breaks, it's the 10 times that it doesn't. That's what takes away your advantage. So let's go to the live market real quick. Let's open up, let me open up my crude oil. Actually, I made the mistake of, I'm opening S&P right now, so let that load up. And when I do, we'll go back and we'll look at that crude oil. And I'm probably crashing my Ninja Trader right now because I'm trying to do too much stuff. So let me ask, and guys, please be truthful. Jeffrey, let's go through the whole process right here. And we'll do it just, what's happened recently. So price reached Fibonacci resistance, and let's go through the whole thing. I had momentum. The triggers didn't break. Do you see this as a termination condition? And guys, a lot of you are getting excited and you're saying, oh my gosh, look at the momentum, look at the downtrend. I'm coming from a strong top. This area has to break, but it doesn't. So does everybody see that as a termination condition? I hope so. Because look what happened. Right off of that area. And then it goes up and colors don't match and there's nothing to do. And then we start getting momentum and we're on our way to the area and we haven't reached it yet. So we sit on our hands. We're waiting for rules to be met. They either will or they won't. And then price reaches Fibonacci resistance and every trigger remains below. Can you give me a Y in the room if you recognize on the most current bar I have an uptrend, I have odds favorable momentum, but I do not have a clear path. Make sense? And then the next bar prints and I still don't. And I still don't. And I still don't. But now this area has the potential to break. Why? Because my small triggers have gotten above the lines. My large triggers are still below, so it's not a clear path. But because of this momentum, ladies and gentlemen, this area has the potential to break. I've got a set of rules to help me pinpoint that tail using a smaller, faster chart. So there's a potential long trade, and we'll go back and look at it after we talk about entries. And then that momentum just keeps carrying it. And there's another one of those tails, and we'll look at this one on a smaller, faster chart. But Jeffrey, these trades are medium probability trades. I'm going to give you a rock solid plan, and this is going to be the majority of your trend trades. But that path isn't considered clear until both the small and large triggers are above any lines in the way. And now my path is clear, and this path is going to remain clear until I reach the next area. So what does that mean? My next problem area isn't until 69.63, all the way up here at resistance. And check out what happens. Boom, 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 bang. Right into resistance, weak triggers, none of them broke, and holy crap, look at the reaction right off of that fib. Guys, this is termination conditions keeping you from forming opinions, keeping you, Jeffrey, if I may, from anticipating what's going to happen next. Be in the moment. And then off of that termination condition, it pushes down to Fibonacci support. I'm into a termination condition again. And it starts to go through, and ladies and gentlemen, now we're at the live market with odds favorable momentum directly into a termination condition, which means that rule number 2 isn't met, which means that my best option as somebody that's trading a pattern that wins more than it loses is to sit on my darn hands and do nothing. So did that clear it up a little bit? Did that help a little bit, Jeffrey? I love it when you guys post in the room and post your questions, because it forces me into saying it a different way, and I appreciate it so much. Here's the great thing though. When we have momentum, when that path is clear, guys, we're going to look for an entry. And you're going to be so precise with your entry that you're going to use a limit order. It means that you get to wait for the market to come to you instead of chasing after price or trying to push a button and time it out. And you're going to wait for that market you're going to buy or sell a retracement. And a retracement is a pullback. And a pullback, guys, it's that fight from the small crowd. When everything on the large chart says up, momentum, clear path, life is good, this is your retracement, that little shove from the small crowd. And guys, you're going to be so precise that you're going to wait at an area, fibs, midbands, and yellow 1-to-1s, and you're going to insist that area is inside of triggers, because triggers are where the market is likely to return. Areas inside are where it's likely to bounce. For brand new users, favorable large triggers, guys, this is the best of the best. Favorable large triggers. And what favorable large triggers mean is that your large triggers, these are the smooth ones. These are native to the 5-1 chart. They're a product of the 5-1 movement. The large triggers and the synthetic triggers. And synthetic triggers are nothing more than the large triggers on your large chart. And let me show you this cool thing that price does. Price pulls away from those large triggers and it snaps back. And it pulls away and it snaps back. And it pulls away and it snaps back. And it pulls away and it snaps back. And one of the gospel truths is that price returns to large triggers on any chart. Whether it's a large, a small, a range, a day, a tick, a stock, I don't care. Price corrects to the large triggers. So the large triggers define where these price bars are most likely to return. The areas inside define where it's most likely to bounce. So every time you look for an entry, I want you to say price is likely to return to the large triggers. Price is likely to bounce at areas inside. So when everything says up on the large chart, when the large chart is screaming north, when there's the best momentum, when there's nothing in the way, this is the look on your small chart, guys, and it is railing to the upside. Railing to the upside, and that fear of missing out kicks in, and you start saying to yourself, man, where's the small crowd? I sure hope they fight. I wish they'd come back. They do more often than they don't, guys. And this reversal bar signals the beginning of the fight. This reversal bar, this down bar, after all of those up bars, after all of your amazing patience, it says, hey, this is the pullback. Here we go. Where's the market most likely to return? Where's that correction point? Well, it's your large triggers. Draw a box around those large triggers and say, these price bars are most likely to return somewhere from the top of those triggers to the bottom of those triggers. I have no idea where, but that's my range. And then you have to say to yourself, I need to create a window. I need to focus on where the market is most likely to continue. And it's most likely to continue with the trend from the areas inside of those triggers, from the bounce point inside of those triggers. So it's likely to return to the trigger lines. Let's draw some pictures today. Let's have some fun. I'm wound up. I don't know why. So the yellow shows me where price is most likely to return. I'll never know. I'll never know where it's going, but I can identify the range where it's most likely to go. The areas inside, there's a white arrow. These are what are most likely to create a bounce. And I don't know if it's going to be the mid band or the yellow 1-to-1s. So I create this window, and that blue shaded box is the range, the window of opportunity. This is where the market is most likely to continue. This is where the small crowd is most likely to fail. Are you guys with me so far on this? I hope so. Remember that the large chart has odds favorable momentum, that the large chart has nothing in the way to create a bounce, which means that you're going to activate a limit order a tick or two above the highest point of support inside of favorable large triggers. Because with all that momentum up, with that clear path up, we don't anticipate the deep push from the small crowd with less money, less influence, less friends. So we're going to catch this one right just above the highest point of support. And then it might go to the lowest point of support. I don't know. It might go to the bottom of the triggers. I don't know. But I do know that anything 4 to 5 ticks below the bottom of those triggers in a long trade is not a part of my equation. Any line outside of the large triggers, this isn't an entry point, guys. We are now in the range where the market should not go. Your ability to pinpoint where it's most likely to continue also identifies where the market shouldn't go. And this actually is where your initial stop is going to be placed, 4 or 5 ticks on the wrong side below those triggers. Guys, this stop is unique to the high probability trend trade, to the 50-50 trend trade. This is a trend trade stop. So in a downtrend, the market is down, the momentum is strong, the path is clear, the small chart is screaming to the downside. And then you get your reversal bar, the signal of the fight, guys. And at the time of the reversal bar, you need to say, okay, where's this price most likely to return? Well, somewhere from the bottom of the triggers to the top of the triggers. This is where the price bars are most likely to go. And then you say to yourself, I need an area inside of those triggers to create a bounce. And I've got one line, guys. I've got one magical line buried inside of those triggers. It's a mid-band. And this mid-band is where the small crowd is most likely to fail. And this mid-band is where the trend is most likely to continue. Your job is to activate a limit order a tick or two below that mid-band and say to yourself, come on, small crowd, give me my entry, because this is where they're most likely to fail. Any line on the wrong side of the triggers, any line beyond the correction point, guys, these are not a part of the equation. Entries don't come from here. This is where the market should not go. Your initial stop is going to be placed somewhere up in this whole mess of lines. And guys, this is your entry. This is the high probability trend trade. So when we talk about those tails on the large chart, let's see what it looks like on a smaller, faster chart. Look at that termination condition holding. I get giddy when termination conditions hold. So here's my small chart. Now I'm going to scroll back. The first tail came right to support inside of those triggers. And that was kind of a short little stutter, little blip, blip, and then off it goes. And then my second tail came right to support, right inside of favorable large triggers. And then it came right back to support, right inside of favorable large triggers. And then it came back to support, right inside of favorable large triggers. 3 hits, boom, boom, boom. And not once did it go where the market shouldn't, below those large triggers. Guys, if you got in at the mid-band, you got paid and probably got out break even. If you got back in, you probably got paid and exited with this third divergence. Because guys, 3 divergences in the same price range may terminate the trend, may stop the market, which means that you might have missed the big move, and that's okay, because you got paid before the big move. And that's going to be your study tool, guys. I'm going to scroll back on a large chart, and I'm going to say, show me one of those tails with all that momentum. Maybe it has the potential to break. Maybe it's already broken and it's a clear path. And I'm going to go back, and I'm going to find these tails. And guys, you've got to do the study. I like this one. There's those darn 3 divergences again. Probably no trade up here. But let's go through the logic of looking for the entry together. And let's see if we can find one that's a little more clear. Let's go back to one of the ones that we just did. What do you say? All right. So this is for you guys that want to be able to do it live. And I'm going to make this huge so that we can see it. And I'm going to come back, and there's my look, guys. So here's my large chart look. This is for you new folks. This is for you guys working on your patience. We're going to pretend like we just woke up and we didn't see this one. Can you give me a yes if you see that the trend is up? Guys, play along with me. This will be fun for you. Absolutely. That's an easy lesson, right? Can you give me a Y or a yes if you see that I have odds favorable momentum? Smalls above the large, larger wide, space between. Yeah? Awesome. All right. Can you give me a Y if you see that the smalls have absolutely smashed, but the large triggers haven't quite made it? Guys, this is that 50-50 look. This is that potential to break look. This is a great look. Most of your trades are going to have this look. So we're done with the large chart, right? We have everything that we need to go look for an entry. So let's do it. This is my small chart. You know what? We'll leave that one up. Let's remind us that this is what it takes. That's it. Perfect, Bob. 50-50. So here's my small chart, guys, and it's going up. And I'm terrified that I'm not going to get a fill, and I'm worried that things aren't going to work out, and I'm scared to death that life isn't going to give me the entry that I need. Does everybody remember? What am I waiting for? Right now, what am I waiting for on this small chart so that I can find my window of opportunity, the point where it's most likely to continue with the trend? What do we need to see on that small chart as it runs up away from us and our fear of missing out starts churning in our guts? Anybody? Waiting for the pullback. And what that means, Jeffrey, is we're waiting for the reversal bar. We're waiting for this one down bar to signal the beginning of the pullback. Does that make sense? Because I think it's important to separate the two. This is the beginning. The pullback is going to be hopefully the distance it crosses back and gets to us. So we've got the reversal bar. The first thing, let's find our trigger lines from the top to the bottom. And guys, that's a pretty big range, isn't it? From the highest point of the triggers, hopefully to our entry, Jeffrey. The reversal bar signals the beginning of the pullback. We don't know how far the pullback's going to go. We don't know if it's going to be a single bar, if it's going to be 3 bars, if it's going to be 6 bars. But we're about to pinpoint where it's most likely to go. How's that? So the reversal bar says, Jeffrey, where are your triggers? From the highest point of the triggers to the lowest point of the triggers. Is everybody with me? What does this define? This defines where price is most likely to return, somewhere in this range. Can you give me a Y? Reversal, but not an arbitrary Y, Bob. I want you guys to understand that we're defining where price may return. That's what the trigger lines tell us. This isn't our entry, right? Because the reversal bar is inside of trigger lines. So now let's define the spot on our small chart where the market is most likely to continue. Where this momentum, where this potential to break, where the small crowd is most likely to fail. And I want you to see this refinement process. I'm no longer looking from the top of the triggers. Price tends to return to triggers, Jeffrey. Exactly. But I'm looking for my highest point of support, which happens to be Fibonacci support, and I'm looking for my lowest point of support inside of triggers. And they all reside right there inside of the synthetic. So we went from very broad, where is price likely to return, to where is price likely to bounce. Are you guys with me? Rob, you don't have to call your trades in the room. Take a picture, write your rules, save that writing for your charts, because I know writing's a pain in the butt for you. You don't have to call your shots in this room. I prefer that you don't. And guys, if somebody in this room says, hey, I'm going long here, don't listen to them. They might be drunk, they might be high, they might be yahoos that have no idea what they're doing. We don't call trades in the room. So Jeffrey, Bob, everyone else, do you see how we've defined the point where the market is most likely to continue? The areas inside of trigger lines. And then the cool thing is, even with the market all the way up here, I know that my initial stop goes somewhere about here, 4 or 5 ticks below the trigger lines, on the wrong side of the trigger. So let's make our stop right here. Make that solid. Even before I ever enter the market, I know precisely where my risk is going to be. Are you guys with me so far? Triggers tell me where the market is likely to return. Areas inside of triggers show me where it's likely to bounce. Guys, our job is to right-click and activate a limit order a tick or two above that highest point of support. And this is what it's going to look like on your charts as you anticipate the pullback, as you anticipate and hope that the small crowd has it in them. Everybody with me so far? And then check it out. Here it comes, but not there yet. Oh, I hope it gets there. And here it comes, and it's still not there. And man, I'm chomping at the bit. I'm fearful. Oh, look at that. They tried to go up, but they didn't make it. We're still coming down. And boom, a tick above that mid-band. And ladies and gentlemen, you are long at 69.19. You're in the highest probability trend trade that I know how to teach. And that becomes your entry. And the cool thing is, once you get this reversal bar, your risk is 2 ticks below at 17. And guys, you have virtually no risk because of your sniper entry. And I want you to see something cool. You see this box that we drew where the market is most likely to continue? Well, if I slide it over to it, that box is right at the bottom of the tail on the large chart. That box lines up with the entry. This is your pattern, ladies and gentlemen. This is the look that you have to learn so that it becomes easy. Pretty cool, right? So Mark, are you saying I don't have to be in a trade to learn how to trade? Well, that's exactly what I'm saying. Mark, are you saying I don't have to risk anything and I can recognize this pattern? Hell yeah. Guys, that's the one. But you have to learn to go through that process. So look what I did for you because I love you unconditionally. Here in the spreadsheet, guys, is that same thing. Here's entry step 1. Rules met on the large chart. How crazy is that? Let's make sure we have the statistical advantage. And then wait for the reversal bar. Guys, I want you to read these and embrace the language. Wait for the reversal bar to signal the pullback. Once I get the reversal bar, it's my job to find the triggers from the lowest point to the highest point. This is where price may return. And guys, the wider they are from one another, the bigger this box is going to be, the more likelihood there is of areas inside of it. But once I make that box, let's find the areas from the lowest point of resistance to the highest point of resistance. It can be red Fibonacci, magenta midbands, yellow 1-to-1s. Create a window of opportunity, guys, inside of favorable large triggers. Why? Because this is where price is most likely to return. This is where price is most likely to bounce. These are outside of the triggers. Don't care about those lines. Once I do that, all I have to do is right-click on my chart and activate a limit order just below that lowest point of resistance. And guys, this is your entry. This is where the market has to come for you to take a trade. And if it does, guess what? You're in a trade that has been proven to win more than it loses, that typically wins up to 70% of the time. You're in a trade with the advantage of momentum, with the advantage of absolutely nothing in the way, with the advantage of having pinpointed precisely where the market is most likely to continue. Guys, this entry is amazing. This is your first entry as a brand new user. And your stop is where the market shouldn't go. 4 to 5 ticks beyond those triggers. So go through the process of studying these entries, practice them, look at them, and learn how to believe them. Jeffrey, how would it get to that point if it's not on a pullback? Hold on. This is your pullback. How could it ever get to the lowest point of resistance? So you're saying, hold on, let me see if I can find it. What if it just blows through this 1-to-1? Well, then it's not a trend trade, Jeffrey. Because a trend trade positively, absolutely, 100% requires a pullback to an area inside of favorable large triggers. What you're looking at here would be something completely different. Does that make sense? We'll talk about this one. This look is what we call a momentum trade. Absolutely, Bob. This look is what we call a momentum trade. But Jeffrey, if you're not good with momentum, if you're not solid with the idea that there's only the potential to break here, because this is going to be your look on any momentum trade that you take, and you have to understand that it takes momentum. That's rule number one. And you have to understand that the small triggers have to get through the area, or even more so, that it's coming from a strong top or bottom. So Jeffrey, what we talk about in the beginning opens those doors for you to take that next trade. It opens the doors for you to see that momentum trade, to understand that HVA trade, to be able to recognize that trade that you see people doing where they just jump in. So we're building this super awesome foundation right now. Does that make sense? I like that you're already thinking ahead though. You'll get there, I promise. I'll even give you a plan to take it. But right now I'm going to do my best to keep you focused on the highest probability trend trade that we take, because this is the one that's going to teach you to read your indicators so that you can catch those other ones effectively. Guys, there are 3 entries that are common for new users. And these 3 entries kind of present themselves for experienced users too. And I'm going to find this because yesterday one of you guys gave me the greatest example ever. So let me minimize this, but let's talk about it. There's the first entry that I see a lot from you guys. And it's the dag nabbit, it's going without me, I'm just going to jump in entry. And it typically happens, you guys finally get the courage to take it right before the reversal bar. And guys, if you're in too soon, if you're keeping your stops where the market shouldn't go, you're looking at from 04 to 40, $340 worth of risk per contract. If you're really going to keep your stop where the market shouldn't go. Guys, that's enormous risk because you've only got 6 ticks to get to trouble. That doesn't seem right. So in the beginning, temper, learn how not to do this. The second one, and we saw this on that little bar by bar that we did, where the market looks like it's going to go up and you start screaming in your brain, oh no, it's going without me, I better jump into this trade. And I see that entry right at the top of this bar, and then sure enough, it pulls right back to support inside of favorable large triggers. And all you've done, once again, is increased your risk and minimized your profit potential. And then eventually, if you study a little, if you ask some questions, if you post some pictures, you begin to trust the idea that the market typically returns to areas inside of favorable large triggers, that's typically where the bounce is. And guys, your best entry is what gives you the least amount of risk, and your best entry is what gives you the most room to get to trouble. And I want you to see this. These were presented in class yesterday, and we hit every one of those, which I think is pretty outstanding. Here is, hold on. There was your entry at the very top of the move, only to pull back to support at the triggers, right? And it didn't work. Here was the head fake when he thought it was going down and it didn't, but rather it pulled right up to the bottom of those triggers. And then there was the perfect entry, and that was his easy winner. And guys, if you don't think these are real, this is from yesterday, and this is from a guy that made about $1,800 yesterday. So you've really got to focus on these, and you've got to learn these, and more importantly, you've got to learn to trust them. And then the cool thing is once the market starts to go in the direction of your trade, that's when we start reducing risk, guys. That's when we're going to move that stop a couple ticks below the reversal bar, a couple ticks above. And your great entry is what creates that minimal risk. And then there's the picture that teaches you how to study it. This is exactly what we did, right? We circled a tail on the large chart when the rules are met. This looks damn near exactly like what we did as a class. And we don't trade the tails, we trade the pullbacks to the areas inside of favorable large triggers. And guys, this is your foundation. This is your first trade. And if you really want to get good at this, you've got to learn these very basic concepts, and you've got to commit them to memory, and you've got to be able to recognize them quickly. So this is for you guys that don't mind putting a little effort into making 6-7 figures a year based on your trading, that want to be chart readers, guys. It has nothing to do with taking trades. It's okay, Marty, you can just excuse yourself. It has nothing to do with taking trades in the beginning, and everything to do with the study that you're doing. And what we did bar by bar, guys, is a great way to do that. And another thing is just go take pictures of strong triggers, and then take pictures of weak triggers, and make sure you know the difference between the two. And the same is true with path and entries. Just take pictures, but don't just take the pictures. Annotate the charts of why they're strong triggers. Why is it a termination condition? What does it mean to me in terms of advantages, or what does it mean to me in terms of my advantage being gone? And if you do that for each picture, if you take the time to annotate each and every picture that you take, what you're doing is you're creating this awesome correlation between what you see, the visual, and what it means to you. I guess the auditory, if you're talking in your brain. And then ultimately, you'll piece these together. You'll piece that momentum, and once you have it, you'll begin to look for that path. And if the path is there, well, then you're going to find your pattern for the entry, guys, and that's what's going to put you into the market. So as you go through this process, I'm also going to give you this. This is the high probability trend trade checklist. And this starts with defining a strong top or bottom. And there's even a video link to my brother doing an amazing seminar on tops and bottoms. But a strong top or bottom is that termination condition that reverses the market, guys. And that's it. It's the precursor to the highest probability trend trade. It's not mandatory. You can take a trade without it. It's not one of the 3 rules. But the highest, best of the best trend trade that you can take happens when it comes from a strong top or bottom. And then you have to be able to define momentum, guys. Strength, strength, weakness. Know the difference. Use this as a cheat sheet. And then there's the things that happen. When price reaches resistance and none of the triggers break through, it's not a clear path. And when the small smash through, but the large haven't, it has the potential to break. Jeffrey, this is going to be your look on that momentum trade. But it's not a clear path until the small and large break, guys. And I want you to see here how the small smashed through, the large didn't, and the area still never broke. It ended up reversing and going the other direction. So I'm going to give you a plan to take this trade, but the rules are different than the highest probability trend trade. Get good at one before you add the next. And then define your entry. And this shows you everything, the whole process, from waiting for the reversal bar, defining the trigger lines, looking for the areas within, all the way down to where your order goes. And guys, if you use the language every time, area inside of favorable large triggers, it builds a lot of patience for you. So I'm going to give you that as well. And then I'm going to give you the KISS plan. And the KISS plan is a stepping stone in your learning journey, guys. And I said it before, and I'll say it again. The high probability trend trade is not your only trade. This is your first trade. This is the trade that teaches you to recognize the other trades. And if you really focus, and I tell people, give it 20 trading days. That's 30 days of your life, 1 calendar month. 20 trading days to get good at momentum, path, and entry, to flood my room with questions and pictures. Guys, after that first 30 days, the other trades are going to start to jump off the page at you, and they're going to become much easier. This plan is your written plan. This plan is your Bible. It is your manifesto to getting into the market, guys. And then through simulation, study, class feedback, and continuous practice, you're going to create your own plan, and that's going to be based on your ability reading the indicators. Because once you're a chart reader, it opens doors. So your simple plan for consistency, don't fight the large chart. If the large chart's going up, go up with it. If the large chart has strong triggers up, oh my gosh, don't go short. And guys, don't trade into those areas on the large chart. Let them break, because that's what creates your advantage. So define your entry. This is the first step, guys, because great entries create manageable trades. Great entries put you in a position to have the least amount of risk. Great entries give you the most room to your profit target. Define your entry. Get good at it. Know where it's at. And then you have to manage. And oh my goodness, management terrifies you guys. Because now you have something to lose, guys. Management is where hope springs eternal. I hope these areas break. I hope it smashes through that one. I hope these weak triggers don't make anything happen. So once you're in on the perfect entry, guys, you have to do something with it. The KISS plan is designed to get you paid and get you paid quickly. And it's designed to teach you where stops are appropriate and not emotion-based. So your management is every bit as mechanical as your entry in the beginning. And it's 100% dependent on your ability to recognize where the market is most likely to continue. It's 100% dependent on your ability to wait for the pullback to the area inside of favorable large triggers. And if you do that, your stop goes 4 to 5 ticks below. And I have this conversation every day. The ATM strategies that are predetermined for you, that are provided for you in NinjaTrader, you've got one with a 12-tick stop and one with a 24-tick stop. The 24-tick stop is for the NASDAQ, guys. And if you're brand new, the NASDAQ is really hard to trade. So your initial stop is 12 ticks. But 12 ticks isn't where it belongs. Does everybody remember the language? Where the market should not go. 12 ticks gives you the reaction time to put your stop where the market should not go. Do not just leave an arbitrary 12-tick stop. Sometimes it may be 12 ticks. Sometimes it may be 15 ticks. Sometimes it might be 4 ticks. Who knows? 5 ticks. I don't know. But put it where the market shouldn't go. And then once it's there, there's nothing for you to do. I want you to sit on your hands and do nothing. Put your hands on your head. Roll back from your desk. You're either going to get stopped out of this trade, which is normal. 20 to 30% of the time, you're going to get stopped out. 20 to 30% of the time, you'll take a loser. Don't ever say something foolish like, I took this one because I needed a winner. No, you're not in control of that. You never will be. All we're doing is we're taking the same pattern every time because it's been proven to win more than it loses, which means that I have to lose now and then. But if it doesn't hit my stop, it's going to give me one of those magical reversal bars. One of those things that say, hey, guess what? We're going up. We're going up with the trend. Our path is clear. Life is good. Here we go. And you're going to move your stop 2 ticks below it. And what you're doing is you're protecting your investment. You're reducing your risk. And there's nothing for you to do at this point. You still might get stopped out. But now you're going to get stopped out for 30 or 40 bucks a contract instead of getting stopped out for 150, 200. And then we start talking targets. And this is based on 2 contracts, guys. And there's 2 predetermined targets in the KISS plan. Bob, you can do whatever you want, man. How's that? You can jump in anywhere. You can put your stops anywhere. You can take targets anywhere. But here's the reality, Bob. If you want the highest chance of success as a brand new user, you got to learn how to get in here and put your stop where it belongs. And you've got to learn to be patient and only move your stop when you have a reason to move your stop, rather than when your guts tell you to move your stop. And at this point, I'm either going to get stopped out for a small loss or it's going to go to my first target. And I said the KISS plan is designed to get you paid, and I meant it. Your first target is $100 away from your entry. That's it. And right now, there's 7 of you in this room that say, Mark, $100 isn't enough. Well, none of you in this room are stepping over a $100 bill on the sidewalk, right? Every one of you will bend over to pick it up. Learn how to get paid. This $100 creates confidence. This $100 really starts to build that trust in the methodology. This $100 dries up your sweaty palms and it makes those butterflies go south. And guys, this $100 is a victory. And once it hits, it's going to take off one of your contracts. Amen, Bob. And you're going to move your stop to break even. And guys, break even isn't your best stop. I'm going to tell you that right now. But break even means that you have nothing at risk. Break even means that you're more likely to hold for the second target. The second target is only $200 away from your entry. And if it hits that second target, if it makes it, that's a $300 trade. That is the highest probability, best of the best, outstanding entrance, pragmatic management, $300 trade. And guys, a $300 trade is freaking amazing. And if that's the best you do every day, that's 75 grand a year based on one trade going the distance, 4 minutes of your life every day of actually being active. Add a break even in there and you're in six figures. And I'm going to tell you right now, if you do the study, if you get the feedback, if you continuously practice, guys, you're going to find that $300 to $400 a day feels too low, and you're going to see the potential to be up in this range pretty solid, pretty quickly, as long as you keep it basic. Guys, and we haven't even talked about the other trades. We're talking about a trade that sets itself up 3 to 4 times a day. Can you teach yourself to be patient? But there's stuff that you have to know. And this is why I'm here. Guys, you have to know why you're going to enter a trade. Why would I enter a trade? Because the rules are true. Because my rules have been proven to win more than they lose. Guys, don't trust me to prove it for you. Go back and circle those tails. Go through, do it, see them, look in the room. You'll know that the software works within a week. If you're on demo, there's going to be zero doubt in your mind that this stuff works. You're going to see people getting paid with it every day. But you also have to know why you're going to exit. And exits are getting the hell out when your advantage is gone and your target hasn't been reached. Maybe it's those 3 divergences in the same price range. I was Skyping with a buddy this morning and I said, man, if that third divergence prints, I have to exit this trade. And sure enough, it printed and I exited my trade. I didn't hope that it went down anyway. So know why you'll enter, know why you'll exit, and then most importantly, understand that for every entry, there's a set of rules for every type of trade. So there's entry rules for the high probability trend trade. There's entry rules for the medium probability, that 50-50, that potential to break trade. There's entry rules for the momentum trade. There's entry rules for the HVA trade. And each trade is managed differently. Each trade has a different set of expectations. So your path of least resistance in the beginning is right here. Learn to enter the high probability trend trade, use the KISS plan to exit, and then you'll create a plan based on your ability reading the indicators. So my promise to you guys every morning is that I'll give you everything that you need to be successful with the software. And I'm about to give you a zip file right now. And that zip file is called Everything You Need. And I've given you, in this zip file, Chart Reading 101. That plan for you to become a chart reader fast, to understand these advantages, to be able to pull them off screen quickly. There's that daily goals reminding you that you don't have to make $1,000 every trade to be successful with the software, but rather the goal is to get paid, to collect money daily. There's the exit conditions. And it's a start to your management plan. It's a little foundational thing for your management plan, guys. There's the high probability trend trade checklist that show you the pictures of what it looks like to have your rules met. So as you go through that 101, you've got a cheat sheet. It's got the KISS plan. And guys, the KISS plan isn't just the high probability trend trade. The KISS plan is also the 50-50 trade in there, your second trade. And then it also has the PowerPoint that I use to teach this classroom every day. And it has all of these things in Microsoft friendly and also in PDF versions. So you have each and everything that you need to be successful with the software. We have discussed the trigger looks for when it's okay to trade. You guys have the ability to simulate, but even more so, you have the ability to get feedback every day on everything that you've done. And that's where the magic happens, guys. The feedback. What did I do right? What did I do wrong? How do I correct it? That's my pledge to you that you'll get that every day. You've got a spreadsheet so that you can track your trades. That same spreadsheet has a bazillion pictures of rules being met. It's got all of your rules and what it means to not have them, and it's got a place for you to build your plan when you start to learn to read your indicators. So the only thing that Nexgen doesn't give you is experience. The only thing Nexgen doesn't provide you is trust. You have to develop that trust yourself. You're going to do that through study. You're going to do that from watching people doing what it is you want to do. You're going to do it from looking at pictures of these patterns so that you recognize them quickly. And you're going to build trust by conversations with me, by showing me what you see every time you take a trade and understanding that each and every day we're going to steer you in the right direction. So if there's anything you're having trouble with, I'm going to recognize it through the pictures that you're posting in the room. If there's anything that needs fixing, we're going to come up with a plan to fix it. If there's anything that's robbing you of success, we'll identify it. And if there's things that are contributing to your success, we're going to high five. And we're going to say, man, let's keep looking at that. Let's keep following that. Let's make sure that momentum and clear path are leading the way. And guys, I'm telling you, the magic comes from the feedback. So focus on advantages, post in the room, learn these looks, and get to where it is you told us you wanted to be. So live market, crude oil. It's an uptrend. The smalls are above the large. The momentum is outstanding, but can you give me a why? Guys, my triggers aren't through yet. This isn't even the potential to break yet. This is still a termination condition. My small chart's starting to show that a little bit. There's one down bar. Here's another down bar. Rule number 2 for the win. Once again, ladies and gentlemen. And rule number 2 is going to define areas that are problematic. And I want to show you guys something cool. And I love it when this happens live. This is right now in crude oil live. Let me go back to the termination conditions section here. And this is a picture from 2021. I want you guys to see something cool because I'm all about the cool stuff. There's 2021. There's today. Do you see any similarities here? There's a few differences. But when I tell you that the market has a memory, that the market is nothing more than patterns that repeat themselves every day. Guys, this is why we're learning patterns rather than looking from trades in the beginning. Because look at this, resistance held and resistance held. And it created divergence and it created divergence. And it came all the way down here and it came all the way down here. And the large triggers didn't follow and it snapped back to them. And it snapped back to them, and it retested the area and the divergence, and the only difference is now we've got a little strength versus some weakness. And guys, if you don't think the market does the same damn thing every day, you're fooling yourself. And down it goes, right off that pivot stop out, right at resistance. The same darn thing. I can't make this stuff up, guys. I don't handpick my pictures because it never happens. We go through the process in a live market. You've got to learn to recognize this so that you can catch it when it sets up. So you can say to yourself, I don't really want to go long from a mid-band right here at the triggers because I don't have a clear path. And on that note, I'm going to take 5 minutes and stretch my legs. When I come back, we're going to look at your charts, guys. Post them if you got them. I'll leave you with crude oil. We'll see what happens. I'll be back in a few. To it, second hour. I don't know about you, but I feel pretty good about that first hour. I think we might have learned something in there. Look how that market reacted off of the fib. Pretty outstanding, isn't it? How many times do you have to see this before you believe it? How many times do you have to trade into one of these areas before you feel like that's not your best chance of success, guys? And that's kind of what trading is. It doesn't cost you anything to not be in a trade, but it typically costs you a lot to be in the wrong trade. So I'm going to scroll up to the top of the room and we're going to see what's going on. And I'm going to share my lesson for today, guys. Be present. Took a long trade, got paid, and I missed my entry. I thought, oh, the trade is done. So I started chit-chatting, and man, I missed it. And that was the barn burner. That was a week's worth of profits. Just wasn't my money. I say I missed it, but I didn't miss it. It just wasn't mine. You can't miss something that you're not there for. And you have to be okay with that. You have to be willing to just let it go. If you're not in front of the market, you can't control what the market does when you're not there. All right, Irish, let's see what we did. We've got odds favorable momentum. Price clears the obstacle. I love that you call it an obstacle. Room to the profit targets. And look at you cranking the 10 lot. When it's perfect, Marty's like, hell yeah. So up $1,700 today. Good job. Have a goal. Don't give it back. But guys, that's it. And notice that he didn't worry about the mid-band, because the mid-band is only a termination condition if those large triggers are a full bar away. And then Ron, he learned that from you, brother. That's what we call the chili dog, ladies and gentlemen. It's not a trend trade. It is a jump in and hope for the best trade. And that was a pretty good example of it. Nicely done, Marty. And for those of you that don't know, Irish MKC is like my little brother. I've known him 35 years. So if you hear me beating the crap out of him, I'm allowed to. All right, let's see what you did, Rob. So everything says up and the path is clear, and you take the jump in and it pulls all the way back and you still stay in, and you're up and you're directly into a termination condition and you're letting it run, Rob. And I don't know what this is doing, but why would you have 11 points of risk as you trade into resistance? Guys, you can move your stops. Bob, it's a little different. JTFI literally means I jumped the fudge in, right? Not worried about anything, just, oh shit, I hope it does what I need it to do. The chili dog has a set of rules to it. The chili dog has the idea of price bars clearing obstacles. It's a different approach. I love it. I'm a big fan of it. It took me a while to learn it and develop a way to teach it. It's the one that I'm teaching my wife. It's the one that I'm teaching Irish MKC. And it has to do strongly with the idea that lines are where decisions are made. Lines are where decisions are made. And when you have momentum and price gets away from that decision-making point and there's not another decision-making point, you can capture these little hiccups in between with all of that momentum and nothing to create a bounce. And that's the chili dog trade. And you guys should all send Ron something nice for Christmas because he shared that with you. And I think it's pretty cool. And then, Rob, you reached your termination condition and you still have 10 points of risk. And you got the close on the wrong side of the triggers, Rob, 1, 2, 3 times. Right off of Fibonacci resistance. And it happened again. Close on the wrong side of the triggers and you'll get out. It's already done it twice at resistance, Rob. And you're just trading. All right. I don't even know what to say about your trades. Because you're saying that you're waiting for something, but when it happens, you're not reacting. Okay, so you're waiting for this one to close. All right. Cool. There we go. I like it. It seems to be working for you. See, I needed that little clarification on your rules. And guys, that's one of the reasons why you annotate charts, so that I can see what you're doing and know what you're thinking, so I can help you with it. And then Sid, let's see what we have. And Jerry, the answer is yes. So entry triggers up, clear path. Not a clear path, Sid. Why not? And you don't have to have the robe as a prerequisite. You earn your robe, Morgan. So Sid, and guys, new folks too. Why is this not a clear path yet? Small and large triggers, exactly. This is the potential to break. Let's see Sid's entry. Where'd you get in, Sid? It's 21549. 21549 is somewhere right in here. So I'm not sure if there was a trade. If you were going to turn this into one of those chili dogs, it's up here around 58. Up here around 58. But the rules, Sid, for that particular trade, the back of the bar clears the fib. The back of the bar clears the fib. Does that make sense? All right, we lost Sid. Let's go to the next one. Rob, we saw that one. Nanda. Any indication about the wick length? In what capacity, Nanda? And yep. Like, how do I know where it's most likely to form? Oh, that's a great question. Watch this. Let's go to Sunday school. The answer is Jesus. If I have an area inside of favorable large triggers, this is where the wick is most likely to form. This is where the tail is most likely to be. I don't know if it's going to be a reverse. I'll never know if it's going to be a reversal or up. But what I do know, Nanda, is that if I have momentum and path in an area inside of favorable large triggers, it's more likely to go up than down. Once I'm on the wrong side of those triggers, I have absolutely no idea. But Nanda, you've got two divergences directly from a fib. That's more likely to go down than up. It happened to go up. Does that make sense? And look at that. I don't know where it's going to happen because I'm on the wrong side of the triggers. And this is a strong trending market at this point. 30 bars in the same direction. So Nanda, when you have this look, the conventional wisdom is buy that mid-band until it stops working. Does that help? And you see that orange stuck order that you have there? If you get one of those that you can't get rid of, there's your fix. You've got to go reset your data, which is going to force you to close the system for a second, but that'll get rid of that hung order. Because wouldn't it stink for the market to turn, to hit that, to put you short, and you're like, I didn't want to go short. Especially right above a fib. You're welcome. Great question. Thank you for posting that. And I like it because I'm forced to say I don't know. I don't know where the market is going to reverse, guys. I never know where the market is gonna do that. But what I do know is where it's most likely to continue with the trend, and that kind of goes back to that very basic. And then Rob, that was your still holding trade. GWC, let's see. Oh, I love this one. Can we talk about GWC's trade real quick? Oh, wow, Morgan. There's your answer. All you had to do was ask, man. You guys know I don't keep secrets from you. So check this out. Not a strong top. These pink 1-to-1s are not termination conditions on the large chart on crude oil. And the market pulls all the way back to Fibonacci support, and the large triggers don't follow. Guys, this is what we call the gap theory. And when the market accelerates away from those large triggers and hits something, if the large triggers are a full bar away, it's likely to close that gap. And the cool thing is GWC knows that. And here it is, right where it hit the gap, and then decisions are made. All of his indicators go green. All of it, everything goes up. And he's like, there's my trade. I'm just going to continue. And he continues right up to the termination condition. And guys, this is awesome because it doesn't have odds favorable momentum, but this is based on a pattern. When a bad top comes and does this, a lot of times they're looking for that next fib. And GWC, you just had it dead to rights. Nailed that trade. Really, really nice. And then Rob, still no reversal bar. And then Rob, still no reversal bar. I do like that you locked some in. And I like this too. You see the bounce on the mid band, you'll add. So Rob, you're starting to think like a day trader. Morgan, update. Why to get out of trouble? Hold on. Why we get out of trouble? So you took the white bar trade. Nice job on the entry. Getting in on the way down. Getting out of trouble. Why do we get out of trouble? Because stuff bounces. Trouble can be trouble. Morgan, dude, you put it together. Nicely done. Taking yesterday's lessons and turning it into cash today. Way to use the lesson there, though, dude. That's perfect. So proud when my kids grow up. All right. So, Rob, you got your reversal bar on the large chart, didn't you? Or your close on the wrong side of the triggers? You were screaming the whole way up that that's why you were going to get out. And then you didn't. And you gave back 10 points over $30. That's crazy. Gotta have a plan. Have a great day, Rob. I saw the gotta run. Guys, if you have a plan, commit to your plan. Would have saved you a lot of money, Rob. A lot of money. All right, Morgan. Oh, jeez. Now I have to go through the Nexgen database and get Ron's address so I can send him this robe. Where should he have gotten out? So, Jeffrey, I'm going to answer this because trading is an individual sport. Where his rules said, where his plan told him to get out. And let me show you something. And Rob, apologies, but I'm about to put you in a spotlight. Let me go to the beginning of it. Oh, that's not it. All right, so this one, he says he's letting it run. This one, he says he's watching momentum, waiting for a close on the wrong side of the triggers. Waiting for a close on the wrong side of the triggers. Waiting for a close on the wrong side of the triggers. Waiting for a close on the wrong side of the triggers. And that was his battle cry for the entire trade, which is cool. It's his trade. It's all right. But then what happens is he gets the close on the wrong side of the triggers. And then another bar. And then another bar. And 10 points in the S&P is $500. Or in this one, it's $50. And that is a huge forfeit of profits. And just following the plan is that 10 points. Could have been out at 84. And I know that you do, Rob. And you know, props on you for holding it as long as you did and following your plan and waiting for it. But guys, this is where fortunes are lost. When you stop following your plan because you want more. And I think they call that greed. And greed is toxic in trading. And that's why every day, like a broken freaking record, I tell you guys, know why you're going to enter and why you'll exit. So, Jeffrey, your entry and exits are unique to you 100%. They're unique to Rob 100%. They're unique to Morgan 100%. But you've got to focus on following that plan. Because the second you abandon your plan, you open the door up for hopes and wishes. And my father-in-law, in his infinite wisdom, used to say, wish in one hand and shit in the other, and tell me which one fills up first. And what you'll find is that it's never the hand you wish it was. So, Rob, I love everything you did about that until you abandoned the plan, brother. But good job. And then there it is again. You guys are killing me on this robe. Marty, I expect to see you wearing one of those. All right, Wayne. Wayne says, let's see if Mark can figure this out. Yeah, you broke your rules. How's that? You broke your rules because you're going to call this a white bar trade, but it's not a white bar trade because you're not coming from a termination condition. So what Wayne did is Wayne said, check it out. The strong trend appears to have ended. My triggers have rolled. I've got momentum. Let me see if I can find an entry somewhere. And it pulls back to fibs on other charts. And I have no idea why these fibs aren't on this chart. Doesn't make sense to me. But what happened is the market reverses. The smalls get below. The large are there. And he pulls back to these fibs. And he's like, you know what? It could go down from here. But I don't know. Look at these strong freaking triggers. I don't want to be a part of that. So he waits for a reversal bar, at least the beginning, gets below the fast triggers, and there's your entry on the way down. I like it. The entry on the way up is just, hey, let's go with the trend. There's probably not arbitrarily selling. Let it roll, get in. Let's see if we close the gap up to the synthetics. Way the hell up there. And that's where your exit was. I like it. Nice trade. So let's see the next one. It's fun to guess. I don't mind guessing. I love that you did that. Momentum weak top. Sim exit entry on same tail and bar. When price is far outside of outer band, the outer band can act as support. Amen. You wait for a close on the other side. I love it. Close as you get close to trouble. Beautiful. Hold on, where's the next one? Entered 2 is the large chart triggers roll. Stop above the synthetic triggers. And you catch it on the way down. First target, second target at the fib. Wayne, I may have nailed the explanation there. I didn't talk about the outer band as support. I said there might be a mid band there or something. But is there a third trade? Target, 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 target. First within seconds, 330 stop, move to 1 tick. Above, second target hit for 480. Am I missing the third trade? 2 sims, 1 live. Entry short. Entry long. Close, close. Am I missing it? Okay. So there's your short. There's your short. There's your target. There's your target. So there's one trade. There's your entry. There's your target. There's 2 trades. Am I missing a third trade somewhere? I only see 2. Well, just because it's 4 contracts doesn't mean that it's 2 trades, right? It's just 4 contracts. That's 1 trade. That's the same trade. Two in, 2 out. 2 in, 2 out. You're making me work too hard, Wayne. All right, so there's 1 trade, right? In that range. There's 1 trade in that range. All right, I believe you. I don't see it. I don't see it. I see target, 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 target. That's cool. I see entry, entry. I don't see the other entries. I see 2 entries on the same bar. And I might just be blind. They told me that would happen. Am I missing it? Blue on the right side is an entry. Pink on the left side is an exit. Pink on the right side is an entry. Oh, well shit, Wayne, you're making me work hard here, man. So you're showing me sim trades and live trades, but you're expecting me to differentiate. I don't have any idea, dude. Great job. Wayne's like, we're going to work the old man today. I'm not mad at you for it. All right, let's not play guessing games anymore. Show me the sim trades and show me the live trades. Don't make me guess which is which and how they're different. That's tough for me. I'm not that smart. You know that. All right, strong top, potential to break, split triggers. You guys want to go through a 50-50 trade? Oh man, well I'm glad I can provide it. I'm sorry you have pneumonia though. I hope you feel better, man. Termination condition, odds favorable, momentum, potential to break. Can you guys give me a Y in the room if you see that the smalls aren't through, but the smalls are through, but the large are, and it's the potential to break, but it's not broken yet? Cool. So when the reversal bar prints, it signals the beginning of the pullback. Guys, this is a medium probability trade because I don't have a clear path. At the time of the reversal bar, let's do some shapes. Price may return to these triggers. Price may return to these triggers. Does that make sense? So I've got 2 correction points. And if I draw a box around it, that's how big the range is where price may return. You guys with me so far? We're just using language of entries. Price could bounce. To be real, it could bounce here. It could bounce here. It could bounce here. Whoops. It could bounce there. So what we're doing is we're using the language of the entry to understand where price may correct and where price has the potential to bounce. So far, so good, everybody? And once you start going through the process of the language, of what could happen and what the entry means to you, you start saying to yourself, well, my stop has to go here at 39. And you begin to work through, is that acceptable risk on a maybe trade, on a medium probability trade? Is that acceptable risk? Is that acceptable risk? Is that acceptable risk on a medium probability trade? Oh, Andy, take care, man. Go hang with your dad. Absolutely. But Jimmy Choo shoes for Barbie are important. So guys, this is one of those things. When my triggers are split and my correction area is huge, one of the things that I like to do is I like to wait for a reversal bar. I like to go ahead and sacrifice a couple ticks so that I can establish my risk. And I know exactly what my risk is going to be. And you notice how it never gave me that? It never gave me a reversal bar off of any of those areas. Morgan, do you remember that lesson for split triggers? How whenever they're split, it creates indecision. And if it's a medium probability trade, and guys, check this out. Not only did it not break this area, it also didn't break this area. So not only do I have two areas that aren't broken, I've got 6 points where it could bounce and a range that goes from 35 to 15. I've got a $200 range where those price bars may return. When you start talking about it in terms of advantages, when you start talking about it and what's wrong with the trade, does it make sense to not arbitrarily jump into the trade here? Does it make sense to maybe force a little confirmation in the direction of the trade? That's where you guys are headed. So when I go to the KISS plan and I talk about the 50-50 trade, and it's in here very specific. Whoops. And I stink at clicking the right link. So when I talk about the 50-50 trade from the KISS plan, and you guys all have this, this is designed to optimize your chances of success. Great job, Morgan. What does that mean? That means that to take this 50-50 trade, this medium probability trade, this I don't have a clear path trade, there's a way to do it that's going to give you the highest chance of success. And it starts with one area not broken, not multiple areas. And it needs to come from a strong top or bottom. And I need strong triggers on both charts. And I need no divergence, guys. And this is the best of the best way to take this. And I'm going to tell you right now, if you took the trade because of the strong top, because of the strong triggers, because of no divergence, and you took a loser, that's okay. You took a really good looking 50-50 trade. But when you go back to the idea that split triggers, and let's go to favorable large triggers again, and let's talk about it. And let me see if I have one for it. So the entry on the small chart, and I'll give you guys this. I wrote out all these little blogs. I don't know what I was going to do with them, but I decided I was going to do something with them. So the entry on the small chart takes that one bar confirmation from the large chart, dissects it into 20 or so bars. And Rule 3 says that you're going to buy or sell a pullback at an area inside of triggers. And Rule 3 language is very important, guys. And the series of pictures offers an explanation on the whys and different scenarios you may encounter. So the large triggers are moving averages, and price typically returns to the moving average, guys. So when you have favorable large triggers, look how there's a circle around the large on the large, and a box around the large on the small. And they're in the exact same place. And this helps pinpoint entries. And this helps reduce risk when it's tight like this. And the same is kind of true here. The areas inside of triggers give you that bounce point. You've got your correction points and you've got your bounce points, and when they're one on top of the other, it's pretty good. But it's important that you remember that price may return to the large triggers. So what happens when you start to create the separation? Look at the indecision that's created. And I guess that was the last picture. So when you get this indecision, and you're like, man, that's not the best of the best. It could go here, it could go there. I just don't know. It could bounce here. It might go all the way up here. This is where waiting for that confirmation bar pays dividends. This is where waiting for a reversal bar for entry creates an advantage. So something to think about there. And let's see if we can make these bigger. Favorable large triggers is always the best. And once they begin to split, it's not as great. So you start going through this process. Does that make sense to everybody? Because that will help on entries, guys. If your entries aren't perfect, and literally my language on this is my entry isn't perfect. So I'm going to force a confirmation bar. And guys, forcing a confirmation bar is great. And Morgan just posted it in the room. I never got in because there wasn't a reversal bar. And how much money do you suppose that saved you, Morgan? At least 100, 150 bucks, right? That willingness to not be in a trade, guys. The difference between the most successful traders I know and the ones that struggle is that willingness to not get into a trade. All right, Jerry, you wanted to talk about the chili dog trade, right? Awesome, we will. So I'm doing... let me try something real quick. Hold on, guys. I just got lost. I apologize. All right, I just sent you something. Jerry S. So, guys, the chili dog trade. What does that mean? That means this is a trade that was developed by a Nexgen user that's freaking brilliant, that is repeatable, that does win more than it loses. All of that's been verified, but everybody screws it up. And what the chili dog trade says is that when I have odds favorable momentum, when I have absolutely nothing in the way, I'm going to look for an opportunity to capitalize on a smaller chart, to make quick profits, and that's the key. And guys, I created a checklist, I created a plan, I did all this stuff, and I'll give it to you. I'm cool with that. But I want you guys to remind Ron that he's pretty, because this is his trade. And I am 100% pilfering it. And I even put rules for Ron. I gave him full credit here. Guys, this is the trade that I'm teaching my wife. And this trade, and let me go ahead and full disclosure, I screwed this trade up for a month before it finally started to click, because it's not just jumping in. But this is a pretty cool one, and it's easy to learn. So odds favorable momentum on the large and small chart. This is a non-negotiable. It's a trade based in momentum. And if you don't have them, it's not your trade. Back of the price bar clears the area on the 13.2. Back of the price bar clears the area on the 5.1. Enter with a buy or sell market. Jerry, how's that for easy rules? Hold for $110 of profit, 7 tick stop. So Jerry, let's go through one. What do you say? Dun, 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 dun. This is how you're going to study it. And I put this in here because, guys, you got to study stuff. So, Jerry, just for grins, I'm going to put a circle because when the back of this bar cleared Fibonacci support, price was right here at 69.40. Everybody give me a Y if you understand that it's not a tick above the freaking line. It is literally the back of the bar clears the fib. There's the top of that bar. Let's go see what it looks like. Scrolling back. Guys, I love circles on charts. There's the top of that bar. Right there. Do you see it? But Jerry, check it out. Lines on the small chart have to be cleared as well. So the back of the bar clears the small chart line right there. And your entry is 69.40, and you would hit buy now. Which means that your target is 69.51. And all you're trying to capture on this chili dog trade is that right there with odds favorable momentum. And I promise you, that's it. That's the whole freaking trade. But what happens? Well, sometimes you guys don't let areas clear. You're like, oh, here we go, and the smalls are on the wrong side of the large. You have stuff in the way. And there it is. Yeah, get the hell out before the momentum goes away, Jerry. How's that for explaining a target? Initially, it's get the hell out. Make $100. Be happy with it. So look at this. Ron, you're a freaking rock star for doing this. Prep. Look for a spot that has 24 ticks of wide open spaces. So 24 ticks from the fib to the next spot. Why? Because you're already 13 ticks into it at the top of the bar. Look for the triggers to be stacked on both charts. So this dotted line is that strong trending market look. Odds favorable. Wait for price to completely clear trouble by a tick or two. Use a 7-tick stop and 11-tick target. Quick in and out, lower stress a bit. There you go. Jerry, this is your picture, brother. That's it. And if you don't have a strong trending market, you better have odds favorable momentum. And one of the cool things that I did for you on this, how to study. I'm telling you guys, I'm pretty efficient when I learn stuff. Anytime price clears, circle it. And see if it fits the small chart rules. So when I go to the circle, that's where it was. Did I have an opportunity? Great way to do it. Bob, have a good one, man. And then on this plan as well, there's pictures of longs, there's pictures of shorts. And this is, I did this because I kept screwing it up, Jerry. Pictures of what it looks like when the rules aren't met. Because I think it's important to know what it looks like when you got to pump the brakes and stay out. So for you new guys, use it, take it. But you have to understand momentum. You have to develop a little bit of patience. You have to understand that it's not a home run trade. That it's a quick in and out trade. That it's a let's get stuff done trade. That it's a oh my gosh, the only thing that's great about this trade is the momentum. So I don't want to hang on to this forever. Because when momentum goes away, so does your advantage. And exit conditions mean that your advantage is gone. And then Jerry, I got a little bonus material for you here. And guys, this is for everybody. Let me find the pictures. So if I'm taking a trade, that is solely based on momentum, guys, as long as I'm left of these triggers, that market's going down. And we'll go look in the live market and you'll see exactly what I'm talking about. The moment I get a close on the wrong side of these triggers, that's it. Momentum's over. I don't know how far it's going to go up. Jeffrey, you guys that are new, you'll recognize this as the signal of the potential pullback that might get you to a trend trade. So as long as I don't close on the wrong side of those triggers, it's going down, guys. Oh, I sure will. And then once it closes on the wrong side, its advantage gone for any trade that is dependent on momentum. So here it is again. As long as I'm on the left side of those triggers, it's going up. Once I get a reversal bar on the wrong side of the triggers, it's game over. My advantage is gone. And what happens a lot is people confuse the expectations for a trend trade with the expectations of a momentum trade. Guys, you got to know what you're getting into so you know how to manage it. And let's open up a small chart and check it out. So Jerry, if you had rules met and you took this momentum trade right here, you didn't lose momentum till all the way up here. And that's where it snapped back to the fib. And then it closes again below and it pushes low again. And the same is true right here. If you found a way in up here and you're left of those, it's down until it gets to the wrong side. And then that's where stuff goes nasty. Does that make sense, guys? There it is again. It keeps going until the close on the wrong side. So guys, I use this trick. Let's say hypothetically, I'm in a trend trade and I get to this fib and my large chart's screaming, and Jerry, I'm like, I think I'm going to hold for more. I think I'm going to hope that this area breaks. Well, if I get a close on the wrong side, I'm going to get the hell out. Because it's telling me, dude, you lost momentum right at a fib. You don't want this. Everything says up. There's my reversal bar. I don't know what the large chart was doing. So if I took the momentum trade, that was my loss of momentum. And it's universal. So the reason that the stops are quick, Jerry, is because this is the small chart on the ES. There's always some sort of nasty little fluctuation, some sort of crappy little give it back fluctuation, right? But wouldn't it be amazing to take a chunk and get out, to take a chunk and get out, to take a chunk and get out, and just keep doing that? Oops, there's my untitled workspace. So let's go take a look. Let's see if we can follow some rules. All right, so if I were going to take this trade, you could probably start looking for it, honestly, with the large triggers there, somewhere right in this range. So from 43 to 54 is probably that chunk right there. Why what, Jeffrey? Why would your entry be somewhere around there? Why was my exit there? Sorry, I want to make sure that I get the right answer to the question. Well, the entry requires me to get the back of the bar above stuff. And if it's sitting on down triggers, for me, that's not cool. So I at least want it above those. And that puts me in a market that's about right here. And then from here, there's nothing in my way, so I'm going to get in, and I'm going to look for 11 ticks. Well, not necessarily. I want it to clear the triggers. So, Jerry, the idea is that you clear a termination condition, right? And guys, this is why this trade confuses the hell out of new users. Clearing a termination condition. Does that make sense? Clear the problem. When is the midband a problem? When the large are a full bar away. So Jerry, here you're anticipating, right? If the back of the bar clears it, I'll take the trade. It never does. No trade. If the back of the bar clears it, I take a trade. So that would have been right here. And let me show you something. There's the circle where it cleared. So if you got in, one thing is you don't have odds favorable momentum. Do you notice that, Jerry? But a lot of you jump in anyway. And then it keeps creating these damn lines that you have to clear. And then the fib update happens. And then it clears. And then there's your winner. Not odds favorable, odds favorable, not a clear path, clear path. I don't chili dog on the NASDAQ, Steve. It's too temperamental for me. But absolutely, I would wait for it to clear. If I were going to, absolutely, I wouldn't change that. And let me show you guys why. I think the whys are important. Does it make sense, Jerry? And I'm telling you, practice, because you're going to screw it up. I want you guys to see something. Do you guys remember that the tails are pullbacks on the smaller, faster charts? Look at the indecision at a fib. Look at the bounce at a fib. Look at the tail at a fib. Look at the tail dissecting fibs. Look at the bounce at the fib. Look at the reversal at the fib. Tail, tail. Well, that one almost had it. Bounce, reversal, tail, tail. Go in the other direction. Tail, tail. Do you guys see this? Every time I hit one of those stupid lines, it creates some sort of indecision. So Steve, NASDAQ's no different. You go to the NASDAQ, these fibs, and I like that, Ron, it's like the starting block in the 100-yard dash. This is where decisions are made, and you can see those fluctuations when you hit them. It's rare that you don't get one. You will get one. You'll get times when it doesn't. But guys, once you realize, I got to get to the good side of that line, I got to get to the strong side of that line. That's when the advantage comes. Oh, Morgan, that's smart. Hold on. I don't know why I didn't think about that. There we go. Morgan just fixed it. Now there's nothing in the way. You guys want to see something cool? Weakening triggers, push down. Not strong, push down. Strong goes down. Weak triggers, push up. Guarantee there was something right there. Strong triggers pushes down. They return. There's your reversal. Weak triggers, reversal. Weakening triggers, reversal. Weak triggers, reversal. Weak triggers, reversal. Guarantee there was a mid-band or a fib right there. Coming off that bottom, strong triggers pushes. Weak triggers reverse. That was a pivot stop out at resistance. I remember that. Pushes down, hits something, turns around, goes up. Guys, this is why odds favorable momentum is so important. Because it pushes a market. And if you're going to take a trade that is reliant on momentum, guys, it better be the best. It better be the best momentum ever on both charts. And that's what's important. So guys, I encourage you. Post those trades in the room if you want feedback on them. If you're taking them, that's cool. That's not a Nexgen trade. That is a Mark stole it from somebody smarter than him and then studied it for 2 months and created a metric butt ton of pictures so that he could teach it to his wife and ultimately to one of his friends. Yeah, Morgan, that's what I do, right? I take a smart-ass comment and I turn it into a lesson. I don't know. I think words are powerful, man, and we say stuff for a reason. And we find ways to turn the things we say into advantages or disadvantages. So there's your S&P. Termination to termination. And after that huge move up, the buyers and sellers are trying to figure out if it's going to go up or down. So guys, there's a million trades. There's so many ways to make money with this software. Did I give you guys this yet? That's not it. Sorry, wrong one. Hold on. This one. I've put all the rules on checklists that I know rules for. It starts with the trend trade. Tech trouble. Uh-oh, Sid. Get with Jason. Nothing he can't fix. It all starts with the trend trade. And the trend trade opens doors, guys. And it opens doors. You know what? I need to put the 50-50 trade on there. Hold on. Let me put the 50-50 trade on there. Do. What does that need to be? That looks about right. All right. So there's the trend trade. Morgan. There's the 50-50 trade. Is that centered? All right, that's better. There's the HVA trade. There's the momentum trade. And then, guys, we called this the jump-in trade. But honestly, that's the chili dog. So let me give Ron some credit. And then, Jerry, there's your management, brother. And I'm telling you, quick profits on the chili dog makes sense. Quick profits on the chili dog makes sense because those quick profits get it before the momentum is gone, right? And let me show you how powerful this trade can be. A chili dog with 10 contracts is an $1,100 trade. It's the same advantages, it's the same clearing the area, it's the same odds favorable momentum. And guys, all it is taking a $100 trade 10 times over at the same time. So you can let your accounts build up a little bit. And notice that he didn't hold it until the fib. And then Jerry, check this out. His reversal bar is the same damn price. Why not just get paid and wait for the next one? Is a pretty sound line of thinking for most people. Good stuff. I enjoy teaching this class. Just want to let you guys know that. This is a fun one. Feels good to win, doesn't it? I don't mind losing. And let me tell you this, guys, I really don't. I used to bug the hell out of me losing because I didn't have any idea what I was doing. Once, have a good one. Teach it to Josh. Make sure Josh knows that one. Give him a little one-on-one. Guys, once I believed in my rules, I quit caring if I won or lost because I know that my rules win more than they lose. And when do problems happen? The problems happen when you say, well, I've got odds favorable momentum, but I don't have a clear path. I'll take the trade anyway. And that's where you skew it. The second you deviate from advantages, the likelihood of success goes down. And that's one of the reasons why if you look at the people in this room that are doing the same thing every day and it looks the same every day and you're like, gosh, all they do is post winners, they're still losing, trust me. They're just not showing you, but they're losing less than they win, and that's how they're getting to where they want to be. And just commit to the plan for entry and exit, right, Rob? You gave back $300 on that trade. That's crazy. That's a lot of money to give back. And if you're on one of those prop firms that have a trailing drawdown, that destroys you. That destroys your prop firm account almost instantly. So I love getting paid at lines. I'm a huge fan of getting paid at lines. And here's a great example for you chili doggers. Why do we let it clear? Because every line has the potential to create a bounce. Good stuff. Good stuff. So now we don't anticipate. We say if my triggers get above 69.75, I'll continue looking for long trades. If my triggers roll, give me odds favorable and a clear path the other direction, I'll look for short trades. But until that happens, does everybody see how rule number 2 has given you an out freaking standing range to insist that the market break out of before your next trade? Does everybody see that? I'm telling you, fibs are freaking amazing, guys. They really are. They're so cool. And I've been with the software for a long time. And John says this, and I feel like he's just being silly, but he'll tell you he's amazed every day at the power of Fibonacci and how accurate the software is to show you where potential tops and bottoms are. And guys, you see the potential all day long, right? All day long you see where the potential tops and bottoms are. And then we give you this plan to determine whether or not you should trade into them, or whether or not they've become a top, or whether or not they're likely to be a bottom. And you just kind of piece it all together. And I always say it, I say it so cocky, and I know that I do. Guys, the software works. The software is, in my opinion, the best software that I've ever seen, and I've seen a lot. And maybe it's because this is my comfort zone. You just got to learn how to use it. This is a $10,000 hammer, and if you don't learn how to swing it, it just collects dust in the toolbox. So my job is to teach you how to swing it. All right, I'm going to take like 2 minutes because I'm full of hydrator, and when I come back, it's your class. And Jen, I owe you a chart read, right? So we'll start with Jen, who's feeling left out and abandoned right now, and I'm sorry for that. And if there's something you want to talk about, guys, let me know. I'll be back in like 2 minutes. Home stretch. Still waiting to see if that breaks or not. Let's see the example that Jen gave. Jen says, check it out, Mark. Odds favorable momentum, back of the price bar clears. Nothing in the way. Out of trouble. Momentum on both charts. It's almost too easy, isn't it? I love this trade. I really do. It's not a part of my trading plan, but I get excited to teach it to people. It's not that I don't like it, Jen. The NASDAQ is a little temperamental, wouldn't you agree? And the NASDAQ tends to overrun areas a little more. And there's a lot of volatility. I like smooth, right? I like advantages. It doesn't mean that it won't work. It means that, I don't know, I've been hurt before. And because of the size and the volatility, the stops need to be a little bigger. And just for a trade like this, I don't like it. Now, I'll take momentum trades. Jen. So on the NASDAQ, I'll take, and let me do this real quick, and I was talking to my buddy about this morning. When everything is up and there's that potential to break, I'll take that momentum trade, that snapback, and try and get in at the fib, because then 2 down bars is what my risk is on a trade like that. And I love that trade all day long on the NASDAQ. But I don't know, there's something about being in the middle. NASDAQ fluctuates a lot, and I'm a little hesitant. So yeah, simulate it. Get 50 of them in there. I've probably taken 100 of them on the NASDAQ, and I found that I get stopped out a lot, and I don't like the win percentage for me personally. Still wins more than it loses, but I don't know. I'd rather wait for trend trades on the NASDAQ. That's just me. That's my own 2 cents on it. I like the momentum trade though. When it's screaming from a good top or bottom, I love the momentum trade on the NASDAQ. I think that's a great trade. And even then, I tend to get in on the up bar. I get in, so for example, on this one, instead of getting in here, I like it to finish up, and then I find it. Okay, cool. Have you figured out how to shut me up with that thanks market makes sense? Is that what that is? Because it works. I don't, Steve. But yeah, crude oil, S&P. I appreciate that, Jen. My buddy Marty's using it on gold with some pretty good success. Anything that flows. And there you go. Ron says on NASDAQ, price can clear trouble 2, 3, 4 ticks and still retrace, and it's not a good market for that trade. And I agree. I agree 100%. But one of the cool things about the NASDAQ is that the momentum style trade, typically gets you to that failure point if you're looking for those quick profits. I love honesty, Steve. I do love honesty. And your mileage may vary, I guess is the best way to put it. Past results aren't indicative of future results, or some people love it, some people don't. Some people like this, some people like that. You know, it's no offense. Never been a big fan of blondes, but I get silly around a redhead. Everybody likes different things. I can't wait to see what you're typing, Steve. Because how do you know if it's right for you? You have to practice it. You have to study it. You have to look at it. And you have to make the decision for yourself. And Steve, I think a lot of yours, you blew out an account in 2 days and 5 hours of trading. Rookie. Steve, my record is 5,000 in 2 hours. The first time I went live. Took me 2 hours to lose $5,000. And man, if I'm going to blow through $5,000 in 2 hours, there better be hookers and blow or something. I don't know. That's that's crazy. It happens though. Sorry, that was inappropriate, and I apologize for that. But we've all done it. We've all done it. We've all. First day, 3,900 in 2 hours. Yep. So how do we avoid it? That's the goal, right? Because we're all human, and we're all going to screw it up. How do we avoid it? Well, one, the memory of pain helps a lot. Touching a hot stove keeps you from wanting to touch a hot stove. And you're still going to have days where you're human, even though you don't want to. And for me, this has been my biggest. This has been my biggest crutch. Yeah, manage your losses before you manage profit. And we all learned about it in a very memorable way. 60,000 last week, Pete. Trading into termination conditions. And then you swore you wouldn't, and the first trade you posted in the room this week was trading into termination conditions. So we go back to what hurt us, right? But guys, if you have a day, so yesterday, I had a day. I'm going to tell you right now, I lost $800 yesterday. And what I did, and it's not embarrassing, Steve. It shouldn't be embarrassing. And I'm telling you, everybody's in this room because we're in the same boat. I lost $800 yesterday, so I have a rule, and I use the method from the ale class. And I've got these amazing areas, and my rule is let an area break significantly. Don't hope areas break. And for whatever reason, guys, I had this huge brain fart yesterday. And I broke that rule 5 times. You'll never have it down, Steve. Which is why you always have to resort to the plan. Because we all get bigger than the plan in our brains. But the thing is yesterday is I didn't do it intentionally. I didn't hope. I wasn't wishing. I wasn't praying for victory. What I was doing is I literally, Steve, I thought I had it down, and I inadvertently omitted one of the most important parts of my plan 5 times. And I lost. And I was like, that's my stop loss for the day. I'm done. That's it. So I didn't blow out. That's great. But I hit my stop loss. And I woke up this morning, and I even told Marty, I said, dude, I broke my rules yesterday, and I had a crap day. So today, I did this. What worked, what didn't work. And I started my day focused on not doing that. And that was my 1%. That was the one thing that I swore I would do better today, was to not trade into a line and to let that line break significantly. And it did great for me. Did wonderful for me. It completely refocused. So I didn't have to blow out a count. I had to have a bad moment. I don't even believe in bad days. I never have. Days are 24 hours long, guys. There's no such thing as a bad day. You have a bad moment inside of that day. And you can recover from it. You really can. But Steve, this is when I need to hear from you the most. And I know what you mean. Guys, when you have those bad days, so 2 days ago, somebody posted in the room, and they're an outstanding trader. But what I noticed on their charts is that they were doing things that they don't normally do. And there's a lot of you in this room that have fallen victim to that, right? Andy, that's not your normal trade. What are you doing? Jen, that's not your normal trade. I know what you do, and this isn't it. What are you doing? Steve, if you post a couple in the room, I'm like, Steve, that's not your normal trade. And you don't have to accept that you're going outside of your plan, but I will recognize it. If I have any experience with your trades, I'll recognize when you begin to deviate from your plan. I'll recognize when you start hoping and you abandon what you normally do. And I don't mind telling you. It doesn't faze me a bit, guys, to give you feedback, to try and get you back into where you're comfortable. And we all step outside of our comfort zone, Steve. We really do. John Novak is my goalie. He's the one that knocks me back into play. And that's what you guys have with me, is I get to knock you back into play. Hey, check it out. Little deviation here. I don't know if you did that on intentional, but this isn't what your plan typically calls for. And usually that's where the light turns on, because the light stays off in your own brain because you're in the moment and you want to win. And I've got the light switches for all of you guys. So if you're having a rough day, and guys, if you're embarrassed to put it in the room, email me. Send me a message. And here, let me give it to you right now. Go, dude, Mark, I'm struggling. Let me show you my last 5 trades. Do you notice something? And I promise you, I'll see it. And I'll give you a plan to avoid it. So don't be afraid to reach out to me, whether it's email, whether it's the direct message here. That's good. Cindy, is that a new profile picture? You change them all the time. I love that. I know every one of your looks now. I love seeing y'all's faces. It makes me happy to know what you look like. I feel like I'm friends with all of you anyway. So, guys, we've got 20 minutes. What do you want to talk about? What's going to make you happy? What do you need help with? So every day, one thing, right? Go study. What's your one thing? Rob, tomorrow your one thing is follow your exit plan. And maybe Morgan, tomorrow your one thing is to repeat that process of avoiding losers by following your plan. Maybe it's not even a negative that needs fixing. Maybe it's a positive that you want to keep instilling until it becomes habit. And I'm telling you guys, this is what makes the plan work, is when you learn how to work the plan. So examples of when price moves to triggers, when triggers are far apart on the small chart. Jeffrey, price returns to large triggers. That's it. I'm not sure how to expand on that or what you want to do with that. And this is where you showing me pictures, you finding examples and go, Mark, let's talk about this look. Most people don't know this. I'm super artsy fartsy. So when you make me try to picture what it is you're picturing, I come up with a million different scenarios in my head. But if you show me the picture, okay, so split triggers, got you. That's what I needed. Thank you for that. For entries, we're talking about entries here, right? So check this out. If you go to the client trades, there's actually a picture that says split triggers. And what this does is it shows you the 2 options. The best of the best, because price typically returns to the triggers. So Jeffrey, when they're one on top of the other, life is good. Life is precise. When they're separated, so there's your separation right there. What you have is 2 correction points. And I think that the language that becomes so important is that price returns to large triggers. So let's find 2 instances. Here's a great example of price returning to the large triggers on the large chart. That's the gap theory. And there it is in real life, where it blows right through the large triggers on the small chart and hits the large triggers on the large chart. And that is an outstanding example. So I've got 2 spots where I don't know where it's going to correct. Does that make sense? Does that help a little bit? So when we're looking for those entries and we're trying to have that success, the best looks are going to come from the overlapping, because price may go to either. Price may return to either trigger line. And you know, let me get it. I don't think I gave you guys this one when I talked about it earlier. Here's a little, where is it? Do. There it is. So Jeffrey, there's one called Favorable Large Triggers. And I try to give you guys these little snippets every now and then because I think they're helpful. So it shows you the best, and then it uses those boxes on the correction point and actually gives you a little definition there too. And here's one called Split Trigger Thoughts. So as you can see, this is pretty common. It's a pretty common idea. And something that is going to rear its ugly head every now and then. Always the easiest look. And then this goes through it as well. So read over those and let me know if they're helpful. I love to do those little snippets. And guys, if there's something that you want me to do a little snippet on, I'm always happy to. Quick little counter trend on the small account. The big fat fib. I love this. So Pete has done some study, and one thing that he's recognized is that when price reaches that higher time frame fib, it almost always creates some sort of bounce, and he's started doing low risk little entries to try and capture quick profits off of that bounce. The BFF trade. I don't recommend it for new users because you'll recognize that it fights trend, it fights momentum. Every indicator on every chart says up. And Pete's willing to take a small risk to go counter for small profits off of it. And I've watched him get run over a lot. But one of the things that happens, guys, is when you trade as well as Pete does, and you're as consistent as Pete is, every now and then you can get a little loosey-goosey. Every now and then you can get a little loosey-goosey. Because you're making your money on the high probability. I don't know, Rob. Show me your charts. I don't have MES charts. Show me your charts. The micro ES is not the large ES, so they're different markets. Squeeze your chart and show me your chart. The micro ES is not the large ES, guys. Different people trade it. It can have different fibs. It can have different fluctuations. You know what? Oddly enough, I have an MES workspace. I haven't opened it in a long time. I don't know what it's going to look like. You did, Gary, and it was a good party. But I did reference you. I didn't say your name, but I did reference you. And now they know. No, I referenced when, and Gary, you and I have been working together for a really long time. There's my MES, Rob. And I'm in tune with what you do. I'm in tune with the trades you take. I'm in tune with how you take them. And do you remember the other day where I said, hey, that doesn't look like a Gary trade? It doesn't look like part of your plan? And that was kind of what I was saying. And I was just reinforcing the idea that when you guys post in the room, I begin to recognize your patterns. I begin to recognize the things you do. So I was actually very thankful for that. We look pretty similar to me, Rob. That's MES. That's MES. You didn't really squish it, but I got 2, 1, 1. I got 2, 1, 1. Looks the same to me. Doesn't look like the ES though, does it? Why? Because it's a different market. It is differente. Hey, look, they broke. And now I have weak triggers. They broke out of the range. Didn't they? We knew where the range was. We just had to let them break out of it. Now we're starting to get that potential. For a minute, there was some max headroom. You're okay. What's a max headroom, Grandpa? All I have to do is say one Spanish word and I get the thumbs up from Cindy. I love the attention, guys. We got a few minutes. What's on your mind? I'll tell you what. While you guys try to figure